everybody. This is Tommy again, and today we'll be talking about a very interesting topic. Very interesting in the sense that sometimes people do not want to talk about this topic. And today we're just going to dive deep into life insurance and just learn one or two things about what life insurance is all about and the importance of getting life insurance. So, on my slide here, I said, what is life insurance? Life insurance is a contract between you and an insurance company. So the insurance company is going to provide financial protection to your loved ones in the event of your passing. It ensures that your family's financial needs are met even in your absence. So that means that no one is saying that you're going to die, but just saying that in the event that something like this happens, then your family is covered so that they are able to maintain the same lifestyle that they had when you were here or when they had a breadwinner before that person passed away. So basically, why do I need life insurance? The first thing I would say is your need for life insurance, it depends largely on your goals, on your situation and what your needs are. So one person, one shoe will not fit everyone. That is one crucial thing that we need to know. But mostly why people might need life insurance is for income replacement for a specific period of time. So if you have some dependents and like I mentioned that you want to just allow them to continue to live a certain standard of living because you are the breadwinner, and if anything happens to you, you want them to still be able to live the kind of life that they would have lived if you were to be around with them. Another reason is to fund education for your children. If you have some credit card debt, line of credit, you want to ensure that if the insured were to pass away, your family is able to cover up all of these debts. And also, if you have a mortgage, you want to get insurance to ensure that if anything were to happen to you during this period that you have to pay back your mortgage, they have something to actually clear out this obligation. So what are the types of life insurance? There are two. We have the term life insurance and the permanent life insurance. I'll be explaining them in the subsequent slide. So what is term life insurance? Term life covers for a specific period. So let's say 10 years, 20 years, 30 years. And I will explain why people do term sometimes. So let's say, for instance, you feel that if you're a 35-year-old man and you have children that are like 5 years, 7 years, 10 years of age, and you're looking into the future that if anything were to happen to you in the next, say, 20 years, these children need you to fund their education through high school and university. So you want to actually find out how much is the cost of their education, and you want to get term to actually cover these expenses. Other times is if you have a mortgage that you need to pay over 25 years. So you want to get a term insurance for that particular period of time, and you want the coverage amount to be able to cover what you're exposed to in terms of your mortgage. Now, so that's why some people might decide to do, I just need this coverage for 20 years. After 20 years, my children will no longer be dependent on me. So I'm just going to get this for 20 years. So people do this for different reasons. And it is affordable, very, very affordable, and provides a death benefit to your beneficiaries if you pass away during the term. Now, one thing you need to know about term life insurance is that you're only covered for the duration of the term. So if you do a term 10, you're only covered for 10 years. After 10 years, the coverage stops. So if nothing happens within the 10 years, that's the end. If you do not pay your premium, which whether you have agreed to do it monthly or annually, if you miss any premium, you're given about 28 to 30 days and like, okay, maybe you forgot you're going to pay this premium. But after 28 to 30 days, that policy is going to lapse. So that means you are no longer covered if anything were to happen after that first month. then you are not covered and there'll be no payout. Now, if you're getting term life insurance, make sure that it is renewable. Renewable in the sense that if after 30 years, if you do a term 30, you want to be able to renew that term if you still feel the need to have a life insurance at that particular point in time without having to go through medical examination. And you know that if you're 35 today and you got term 30, in 30 years time you're going to be 65. At 65, old age happens. There are some form of illnesses that weren't there when you were 35, and at 65 they are now there. So you want to get a renewable term so that at that particular point in time you can renew, but without having to be subjected to medical examination. It doesn't mean your premium will get cheaper. Usually it's even more expensive in old age to renew a term policy or to get a term policy. So it's cheaper when you're younger. And the other one is, or you get one that is convertible. Convertible means that you can convert it from term to permanent. So if your term lapses, if your term coverage ends, if you have a convertible term, then you're able to convert it to permanent life insurance. So what is permanent life insurance? As the name already says, permanent means permanent coverage. It provides coverage for your entire life. So it doesn't end after 10 years, it doesn't end after 20 years. It covers you for your entire life. And it includes two main types. We have the whole life and we have the universal life. These policies, they not only offer a death benefit but also build cash value over time. We're going to explain this in the subsequent slides. And this cash value, you can access it or use it to supplement your retirement income. Now, what is whole life insurance? Whole life insurance, briefly, I'll just say it provides lifelong coverage. Your premiums are guaranteed throughout the payment period. So let's say that today your premium is $200 monthly. You're going to pay the same amount throughout the duration of this coverage. And a portion of your premium goes into a cash value account, which grows over time on a tax deferred basis. So when you pay your premium, there's a part of your premium that is being put in a cash value account, and then the money in your cash value account is being invested for you, and whatever income you are generating in that investment you're getting it on a tax deferred basis. So you're not paying tax on it, so it's tax sheltered. Then you're able to get compounding interest on the income from the investment in your cash value account, which could be significant on the long run. Now, whole life also offers what we call those known as participating policies. They may, so it's not like they will, they may, depending on the insurance company, they may pay out dividends to policyholders. So these dividends, if the insurance company has made a profit, they may decide to pay those that are participating dividend. So you can decide to use this dividend to increase your death benefit. You can decide to even receive it as cash if you want to. And also you should note that in comparison to term life, in whole life you pay a higher premium. So the second type of permanent life insurance is universal life insurance. This covers what if life is short. So what if this person dies next year, or next 5 years, or next 10 years? You're covered. That means your beneficiary is going to get a payout based on your coverage amount. Now, what if life is long? So that means this person didn't die but lived to age 95, thereabout. So we're going to say this: universal life combines the insurance component and the investment component. The insurance covers what if life is short. The investment component covers what if life is long. So if life is long, you want to have put in enough money towards retirement so that you don't go cash strapped in retirement. So when you pay your premium under universal life, excuse me, when you pay your premium under universal life, you have access to your cost of insurance, you know what your cost of insurance is, you know what the policy charges are that is being taken away, then the rest of your premium goes into the investment component of your policy. In whole life, you usually do not have that option to choose um, what um what investment you are putting your money into. You don't really know how much is being taken as cost of insurance. You don't know what your policy charges are. So, but you just know that you have cash value in whole life. In universal, you actually have an idea of how much is the cost of insurance, what are the charges, and then you know how much of the rest of your investment that is going into rest of your premium, I beg your pardon, that is going into the investment component at the end of the day. So you can, in universal life, you can actually overfund your premium. So you can, this much can decide to pay less, next month decide to pay more. So let's say that, for instance, if you're paying $200 monthly, a percentage of that 200 is going to your cost of insurance, a percentage of it will go to your policy, the policy charges, and the rest of it goes into your investment component. So you can, there's always a maximum per annum that you can fund it to, and there's also a minimum is the basic that will at least cover whatever cost of insurance and policy charges associated with that particular plan that you have gotten. And the premium here is variable, so it varies, so it's not like set cast in stone like you have with whole life. This actually varies. In insurance, there's what we call riders, and riders means in addition to your coverage, you want to enhance your coverage. So let's say you want to add your child under your plan, so there's a child, there's a children riders for children, for adding your children to your plan. There's also what we call critical illness rider, and this means that if anything were to happen and one has any of the illnesses, critical illnesses that are covered under the plan. I'll give an example, like stroke, like cancer. There's a lump sum payment that is being paid out to the insured, that is to cover all the costs that might come in from this illness. So maybe because the person is ill, they're not able to work, there's a lump sum payment which has been agreed ahead when you are getting your contract in place. So this lump sum is being paid when this person, the insured, is diagnosed with the covered illness. Now, the next one is, there's also the disability rider, which I mentioned there. This is when a person becomes disabled and you're not able to work. So they're able to offer financial support in situations where this has happened. So this does not even affect your death benefit. It's just a rider, an addition, like an enhancement of your coverage. Now, what are the factors affecting premium? Age. That's why they'll tell you that the best time to get insurance was yesterday. The next best time is today. So if you get the premium quotes that you get today will be less than what you get in the next 5 years, because you are aging, and with age, the higher the premium you pay. So whatever stage you are in life now, if you do not have life insurance, you want to get it as fast as possible so that you're able to get the best premium quote that you can have available for that age that you're in. The next one, I'll say, it's sex. According to statistics, this is not me, it's believed that women tend to live longer than men. So that means that if you're a 30-year-old woman and another 30-year-old man, there's a higher likelihood that the 30-year-old man is going to have a higher premium to pay than a 30-year-old woman, because they believe that women actually live longer than men. So that also affects premium. Also, health condition. If you have any underlying illness, that could also affect your premium, because there is a larger risk at stake here that the insurance company is taking up on your behalf. Smoking status. A smoker, one thing I always say is, please do not lie. When you are filling your insurance form, don't lie. If you're a smoker, say it that you're a smoker. If you have an underlying illness, you really want to disclose that. You don't hide it because you're trying to get a good premium. Say it so that all of these things will be factored. Let the insurance company decide that they want to insure you or not. You don't want to pay all of this premium and at the end of the day you don't get a payout. So please, number one rule, do not lie. You want to be as open with your financial advisor as possible so you're able to get the best. Now, another factor affecting premium would be your coverage amount. That means if I want a coverage of $200,000 and another person wants a coverage of $1,000,000, obviously, the person going for $1,000,000 is going to have to pay more premium than the person going for $200,000 based on your needs analysis and the policy type. Are you going for term? Are you going for permanent? Like I said, term usually is cheaper, relatively cheaper than the permanent life insurance. Okay, so I've mentioned this all through this presentation, the importance of life insurance. Life insurance is not just about you, it's about your loved ones. It's a way to show them that you love them and that you care about them, so that even when I'm not here, I want you people to be good. I want you people to still live the kind of life you would have lived if I was with you. And also another thing to consider is the fact that even if this person lives long and then you become a grandma, it's also essential for estate planning process. You want to actually leave something for your beneficiaries, your children, your grandchildren, and all of those things. You make sure that your family's future is protected. You want to make sure that your children are still able to have the quality education that they would have had access to if you were to be around to provide for them as the breadwinner. Now, proceeds are tax-free. And this is key, like I've mentioned before, in estate planning process. You can designate a beneficiary. When you designate a beneficiary to your life insurance contract, it means that the payout your beneficiary can be paid directly by passing probate and all of the probate fees. So the insurance company can actually pay out to your designated beneficiary. So make sure that you actually designate someone as a beneficiary when you take up your plan. Now, I get this question a lot. People say, but my employer already provided life insurance for me. Yes, fantastic. But one thing you need to know is that most employers, the coverage you get from the life insurance that your employer has provided for you, usually about 2 times, at most 3 times of your annual income. Now ask yourself, your 3 times of your annual income or 2 times of your annual income, will that cover your insurance needs at this time? If it's yes, fantastic. That's okay. If it's no, you want to actually speak to a financial advisor so that you can get a plan that covers the rest of the need that what you have with your employer does not cover. And sometimes this employer provided life insurance is not portable, meaning that when you leave this company today, you stop being covered under that group plan. Though sometimes some of these insurance companies, they come back to you and they say, oh, do you want to continue your plan? But usually you're going to pay more premium, because group plans sometimes based on the negotiation and agreements is usually lower that the employer is paying. But now that you're your own, you're going to pay more. And let's say that you've been with this employer and the time you're leaving this employer, you're older. So that means whatever premium they're going to quote for you at that particular point in time will be might be more expensive than what you would have gotten if you did put in your plan in place today. So finally, please consult a financial advisor. This is because getting the right life insurance policy can be very overwhelming, because you're not sure, do I do a term, do I do a permanent life insurance, which one works for me, based on your needs, based on your budget. Your financial advisor can assess your needs. They can assess your needs and recommend a suitable option for you. There's something I also didn't mention, is the fact that sometimes you can layer your term insurance and permanent insurance. So that means if I feel that what I need right now is a term 20, because after 20 years I feel that I'm not going to be responsible for my children. They'll be grown enough to take care of themselves. Maybe it's a turn 30, that in 30 years, even the last child in the family will be good and they can stand on their own feet. So I might not need that much coverage in my later life. Maybe the only thing I might need is funeral expenses, and that's just what I need. So you can layer your plan and put in a larger chunk of your coverage on a term life insurance, and then put a lower coverage amount on your permanent, so that even when the term coverage goes off after 30 years, you still have something as your permanent life coverage that you can actually, your beneficiary can have access to when you eventually pass away. So please reach out to a financial advisor. They can help you navigate the complexities of insurance and make sure that you're getting the right quote. So make sure you're getting the right quote, make sure that your needs are being accessed and met. Thank you so much for your time, and thank you for listening.